Do you have an FHA, VA, or USDA loan? Tune in next for some important information. You're definitely going to want to watch this one. Do you have an FHA loan, a VA loan, or an USDA loan? If you do, you're going to want to watch this video with Kevin Sutera from Mortgage America, because you can sell your mortgage and sell your house. The lower payment you have locked in could be assumed by a new buyer, causing your home to be worth more. Watch this video, and if you got questions, get in touch with a professional, because there's an opportunity here for you to cash in.
Hi, I'm Kevin Sutera from Mortgage America, and I want to talk to you today about assumable mortgages and how you can use them as tools to help you sell homes. So I want to start with the definition of what an assumable mortgage is. An assumable mortgage is any loan that can be taken over by the buyer of a home from the seller at the same rate and terms as the existing mortgage. So what is the advantage of an assumable mortgage and how do we use them? Well, timing is the key. No one has talked about assumable mortgages for the last several years because rates have continued to decrease through the years. But in the current rate environment where rates are increasing, an assumable mortgage can be a powerful tool because you probably have a rate lower than the current mortgage rate. The obvious advantage to a buyer is a lower rate, means a lower payment and more affordability. To a seller, if you're able to offer a rate lower than the going market rates, your house is going to be more attractive and potentially you could get a higher price for the house. As an agent, you can use this as a powerful tool in your listing appointments because you're offering value added to a seller that may not have thought about this, and you can put it on the postings that assumable loan is available. So what are some of the particulars and tips about using assumable rate mortgages? The first thing to remember is the buyer of the home will need to be qualified by the lender currently holding the present mortgage. There's no such thing as a blind assumption anymore. The buyer will have to qualify. The equity difference is another question. So the equity difference is the difference between the purchase price of the home and the balance on the mortgage. The buyer will have to come up with that money. They can do it either with their savings, they can get a gift, or they may be able to get a second mortgage to bridge that gap. Getting that second mortgage would have to be at the permission of the bank holding the current loan. For VA loans, believe it or not, you do not have to be a veteran to assume a VA loan. But if you do that and that happens, the veteran selling the home does not get their entitlement back until the loan is paid in full. For a USDA loan, obviously when the home was purchased, it was in a USDA zone. But USDA zones change sometimes, so you have to be sure that the home is still currently in a USDA zone. So those are just a few of the ideas and tips, just the tip of the iceberg about assumable loans. If you have any further questions, please give me a call. Kevin Sutera, 610-212-7461, or you can email me at kevin@mymortgageamerica.com.